Welcome, welcome, welcome. This is Cooper with Fed Retirement Weekly, episode number 4, I believe. I'm with FedRetirementPlanning.com. If you haven't checked out the website, please do so. There's tons of articles that I've written that are in-depth, at least I hope they are, and helpful to federal employees and just general retirees, actually. But this week's question has to do with federal employee group life insurance and mainly has to do with option C. And the question essentially was, how long can my kids stay on my option C family insurance? First of all, the family insurance, option C family insurance from federal employee group life insurance, in reality is a pretty good deal while you're young. Now as you get older, as with all FEGLI, mainly option B, it increases in price to a point that it's somewhat, at least with option B, it's mostly unaffordable in reality, but at least for option C, it's not necessarily unaffordable, it's just not really the best way to go about purchasing insurance. And one of the reasons is because of this question, in that you can't keep your kids on, option C for eternity. So the age that they can stay on federal employee group life insurance is they must be unmarried and under the age of 22. Now, once they reach the age of 22, they're no longer allowed to be on unless they're, handicapped or something like that. Then they're allowed to stay on if, special needs or things like that. Now, I basically pulled the premiums, and for a monthly premium, let's say that you're age 35, you're starting out family, you've got option C times 5, because option C is like option B. You can choose up to 5 times the option, so that means 5 times $2,500 for each child, and up to 5 times $5,000 for your spouse. Okay, so what that looks like is, for your spouse, that would be $25,000 in death benefit. If they were to pass away, that's what you would receive. And if your kids were to pass away, it is 5 times $2,500, and that would be $12,500 per child if you had option C times 5. So that's what you would receive if one of them were to pass away before the age of 22. Now, I pulled the premiums, and I just wanted to calculate for you kind of what it looks like on cost. Let's say you're 35, you're starting a family, a young family, you want to take care of your wife. You want something if your wife is to pass away, even if it's something small like this, or you want something if your kids are to pass away. Then we kind of look at the cost. The cost currently for age 35 would be 74 cents per month per multiple. So all you do is multiply that times 4. That's 74 times 5, that's $3.70 a month, okay, and then just multiply times 12, that would be $44.40 a year. Now, to have coverage of $25,000 on your spouse and $12,500 per child for $44 a year is a pretty good deal. I mean, in reality, if you go outside the system and try to qualify for life insurance, it's probably not going to be that cheap. I don't know if it would be much higher than that, but this is a pretty good deal while you're young. And that's kind of the thing with federal employee group life insurance. It's great while you're young. Now, as you age, that kind of diminishes, and as you'll see, when you turn age 65, the premium shoots up to $6.50 per month, okay? Now, I'll be the first to tell you, life insurance is very important. In fact, it's one of the most important things that I think is involved in retirement planning. Because if you don't have something set aside for your family when you are to pass away, that's not protecting your family. That's my opinion. I believe it's important to have it. I think automatically you should try and qualify for insurance outside the system and just see what your premium would be. Because by taking a health exam, you're not committing to purchasing it, you're just committing to getting a price. Once they come back with the premium, then essentially you can decide which one is cheaper for your family. But something to be aware of is option C, option B, they increase in price as you age, so does option A, but they increase in price as you age and get to a point that they're very expensive. So although you may pay a little bit more now for commercial life insurance, in the long run, you typically pay a lot less, and I mean a lot less. But just to show you, when you turn 65, okay, you've got some kids that are out of the house, okay? Before, you know, you had 3 kids that were under 22, okay? So you were paying $44.40 to cover 3 kids and your spouse. Well, now you're 65, the kids are no longer in the house, they're above age 22, and so you're gonna pay $650 a month times 5. So you're gonna pay $32.50 per month, and then per year, you're gonna pay $390. So you're gonna pay $390 a year, essentially to put $25,000 on your spouse, okay? Now, is that a good price? Like I said, you need to compare the rates. I don't think that's a very great price for the amount of insurance you're getting. You know, I think you can get better, and if you would have chosen to take it earlier on, or if you would have chosen, excuse me, to look at commercial life insurance earlier on, you know, then you would have had a better option. So that's why I always tell people, try and qualify as soon as you can, just to compare the price. You don't have to choose it, but just to compare the price. But that's a great question on option C insurance. Hopefully that's helped some of you. Appreciate the question. Keep them coming. I will keep doing weekly videos. If you have any questions, you can leave them in the comment section. Feel free to email me. There's a link in the bio below. And let's keep this rolling.